Good day, Golearners. We are on the fourth module. Today we are going to be discussing financial statements. Financial statements are the basic language of money and business. They form the basis of financial literacy and the report cards. We call them the report cards of capitalism. Now, as a good investor who wants to invest in the stock market, you have to have a basic knowledge on, if not a deeper knowledge, you have to have a basic knowledge on how to read and understand financial statements. Now, knowing how to read and understand financial statement is a business skill that you can't ignore, because over time you will be able to climb the corporate ladder because you have this basic skill of understanding what you need to look at while analyzing a company. Now, the financial statements, there are three types of them. We have the balance sheet, the income statement, and the cash flow statement. Now, the balance sheet shows the firm's or the corporation's assets and liability and the net worth of that corporation. The income statement is also called the profit and loss statement. It shows the net income of a firm over a stated period, over a fiscal year. If you note from the previous module, we talked about fiscal year. A fiscal year is the year every company runs. Some companies run from March to the next year's March. Some companies run from January to December. So the cash flow statement, it shows the inflow and outflow of cash due to a firm's activities during the period. So we are going to go in deep into these three types of financial statements, and once we are going there, I will be able to tell you the key things you need to understand while reading a financial statement. Now, the balance sheet. The balance sheet is, as I said initially, is a statement that shows the financial position. It shows the financial position of an enterprise or a corporation over a specified date. So it's usually from the last day of accounting period. So when I mean by the last day of the accounting period, by the end of a fiscal year or at the end of a quarter, the accountants or the group of accountants come to tabulate the company's net worth as at that period. So it's usually at the last day of the accounting period. So amongst other information you will find in the financial statements are the assets. Now, the assets is what the company owns, the entity, the corporation owns. How it's paid for these assets, how the company bought these assets it owns, what the company owes. In the balance sheet, you'll be able to know what the company is owing, what the company owns, and you would, at the end of it, you'll be able to see what is left when the company has paid off what it owes. Now, the balance sheet works on a simple formula. So the balance sheet shows what the company or the corporation or the entity owns, what it owes, and its net worth. So it uses a very simple formula. I call it ALE or ALE. We call it, this is the nickname you can use to. It says assets is equals to liabilities plus equity. So it means that, conversely, it means that if you were to take what the company owns and deduct what the company owes, you get the net worth of the company. If you were to take out what the company is owing from what it owns, you would get the net worth of the company. So this is what a very simple example is when you own a shop or a business where the assets you have, let's say someone that sells books. So once you are selling books, the books, the shop, everything physical there is the assets. Now, the balance sheet will tell us how you got those assets. Is it by taking up debt? If you take up debt, then that will be in the liability section. To be in the liability section. So the balance sheet gives us this basic information. So if we're to get the net worth of that business, we'll take out what you've used to get those assets and deduct it from what you own, then you get the net worth. So the moment the liabilities is higher than the assets, the business is said to be bankrupt. So many of these corporations will say they will file for bankruptcy. It is a legal term in law. So there are basic calculations you need to do when you are trying to calculate, bring out ratios from the balance sheet. Now, the first thing you need to understand is that under assets, there are two types. We have the current assets and the fixed assets. Now, the current assets are the ones that can be converted to cash within a year. The fixed assets are landed properties. No, they are things that are needed for the daily operation of the business, like the buildings, the plants, the equipment, and the like. So these two are the types of assets you see under the balance sheet, in the balance sheet. Now, for the liabilities, we have current liabilities and long-term liabilities. Now, as I said, liabilities is what the company owes, right? So the current liabilities are the debts that can be redeemed within a year, within a period of 1 year. While long-term debt, we call that long-term debt in the sense that, or non-current liability, it is liabilities that can be sorted within a year and above. So there are some debts you collect, a company takes on, that can be sorted in 10 years time, in long periods of time. So the basic calculation you need to understand is that when you take the current assets, right? The current assets. What are current assets? Current assets are the ones that can be converted to cash immediately, today. Like if you have to convert money to cash, if you have to convert those assets to cash today, those are current assets. Now, if you have to take the current assets and divide it by the liabilities, what are the liabilities? What the company owes, right? It should be greater than 1.5. So this means that once it is greater than 1.5, the company is healthy. It means that if the company is to sort out its liabilities today, if the liabilities, the entities the company owes, the people the company owes, comes to ask for their money today, the current assets can sort it out. If it is below 1.5, then it is shaky. You can do this for your personal finance when you are sit down and try to see how your finances are going. Once it is greater than 1.5, you are doing well. So equity over assets. Now, remember what equity is. Equity is the net worth of the company. Now, if you divide your net worth by what you own, if you divide it and it's greater than 50%, that company is doing well. You can apply this same formula to your personal finance, and you will see how far you are going. If for example, now let me give a very typical and real life example. Now, a person has assets worth 1 million, and he has liabilities close to 900,000. What would the equity be? 100,000. So if I could do this calculation, it means that 100,000 divided by 1 million that's 10%. So the personal finance, this person in this scenario is not doing well financially, because you will know that the liabilities is more. Are you getting me? So that's that for the balance sheet. So the next financial statement we're going to be talking about is the income statement. Now, the income statement is summarized as the revenues less the expenses is equals to the net income. So it means that the net income is also called the profit or the earnings. So the terms profit, earnings, and net income all mean the same thing. Profit, earning, and net income, they are the same thing. So the revenues is often called the sales and are represented on the top line. If you look at, if you are looking at if you are seeing what's on the screen right now, you see that the net sales is what we call the revenue. So once we take out the expenses from from the revenue, we'll have our net income. So revenue is basically the sum total of the profit I've gotten from the sales of my goods and services. When I now take out the costs, now I sell books, for example. Now, if I'm to take out the cost of transporting these books to the buyer, the cost of getting the logistics and everything, that's the expenses. Now, if I'm to deduct it from the goods sold, when I sell the goods and I get my money, if I'm to take out the expenses, what will be left is called the net income. So the income statement is basically telling us about how a company runs. You'll be able to see the daily operations of a business are measured in the money that comes in as revenues. So if you want to see how a company has been, a company like Amazon, for example, if you were to look at the last fiscal year or the last quarter's revenues, compare it to the current one, if there's an increase, it is fine. But there's a loophole there. There's a loophole. If a company doesn't know how to dial down its expenses whilst running its daily operations, then there's a problem. When a company, for example, a company can be making 1 million naira as revenues at the end of a fiscal, let me say at the end of a quarter. At the end of every quarter, now a quarter is every 3 months. So there are 4 quarters in a year. So when at the end of every quarter, if a business or an entity or a corporation makes revenues, every corporation makes revenues, but if they don't know how to dial down their cost of delivering those goods, cost of goods, the COGS, cost of goods sold, is also known as expenses. We put it as expenses. It sums everything up. If the expenses are still getting higher or increasing, then it is still a zero-sum game, because the profit, the net income from the previous year is meant to be higher than, the net income for the current year is meant to be higher than the one of the previous year. So if the company doesn't know how to manage its expenses well enough, then the management is not doing well in managing or handling the expenses of that entity, of the corporation. So the revenues are usually from sales of products or services. Expenses are what you spend to support those sales. While the expenses might include salaries, raw material, manufacturing, processing, equipment, maintenance, offices, consultant, lawyers, all these things will be embodied under expenses. So once you've taken out all the expenses from the revenue, that's when you have the net income. So if there's no significant increase in the net income, then there is something shaky about the company. You'll be able to know, just looking at the income statement, you'll be able to know how the company is doing. Now, from what is on my screen currently, you can see that this company B, had a net sale of $4,358,000 worth of net sales. That's the revenue. Now, the cost of goods is around $854,000. Now, when you have to take out, when they total all the expenses together, we're having a net income of 483. Now, can you see how everything played out? We have a revenue of $4 million, and we're having a net income of what? 483,000. So that shows that the company has not, I know most companies, most management, you know that the management is not doing well enough in handling the expenses of a business. So you can actually know the behavior or how well the management is handling a company or a business by just looking at the income statement. So the next financial statement we are going to be talking about is the cash flow statement. The cash flow statement. There's a saying that cash is king. It means that when there is cash, things can be done. So the cash flow statement is a continuation of the income statement. The top line of the cash flow statement is the net income. Do you get? What ends the income statement is the net income. When you take out from the revenue to all the expenses, deducted all the expenses. Look, if you can look at my screen, I deducted all the expenses. Then what is left? The last line on the income statement is called the net income. Now, the first line of the cash flow statement is the net income. So the cash flow statement is basically a continuation of the income statement. So the cash flow statement reconciles the income statement with the actual cash position of the company, the balance in retrospect, in layman terms, the balance in the bank account. Now, a company can be having a net income of $1 million, but it doesn't have $1 million in its bank account. It doesn't have $1 million as cash. So the reason why this financial statement is very important is because we need to know, in case of non-cash event, in case of events that come up where the company needs cash to run it, how well can it do it? You know, if you can relate to what I showed on the board that time, where I said if those people the company owes comes to collect their money now, can the company pay? You know, I gave a scale. If it is greater than a number, 50%, then it is good. So if it is greater than 1.5, it is good. So it means that when a company, if the current assets, there are some numbers in the current asset that are fixed into the cash flow statement. So it shows that there is cash at hand, where if in case you want to know whether the company can actually do this thing, pay up their debt or pay up any unforeseen circumstances that might come up. There's a time, if you had to notice, if you know flour mills in Nigeria, there was a time they had an accident. One of their plants in Apapa Road had one accident, and over time, the company was not able to fix it immediately. So investors, you know, when I said in the previous module, when I said value is a perception. So the investor perceived that the company is flour mills, FMN, that's the ticker, are not doing so well handling their cash. So the price plummeted, it fell drastically. Well, over time, they were able to find ways to, because when I say a company is having a net income of $1 million, it doesn't mean it has $1 million in cash. So it means that there are still other payables. There are people that owe the company money and it is still tagged as cash to them. So when flour mills are able to gather up enough cash, they were able to repair that plant. So the price rose 30% from the point it fell. But I don't want to make you understand that at that moment, they were not cash flexible at that moment. You were able to know that by looking at their cash flow statement. The cash flow statement gave us that information. So the cash flow statement reconciles the income statement by adding and subtracting revenues and expenses that were properly recorded in the income statement, but are non-cash events. Now, non-cash events are expenses that have been properly associated with obligations. So it means cash that has not yet changed hands. So when I mean cash that has not yet changed, cash that has not entered their bank account, but it's still termed as cash coming in. So whenever a company writes, this is our net income, don't term it as this is what they have. It is not the exact figure, because they might still have. So the cash flow statement is one telling us everything. So the cash flow statement they have sections in the cash flow statement. We have the investing section, the financing section, the operation section. So these sections are the ones that tell us what the company has been doing with this cash. So the operation section of the cash flow statement, they are related to the operations, the daily operations of the company, and they are also reported in the cash flow statement. The investing section is where the money that has been spent on capital equipment. So you would know whether the company used some amount of cash to buy so equipment or plants or for maintenance or anything. It is written there in the cash flow statement. And the financing section comes in to show us the sales of their products and loans that they've taken in. So if a company has been taking up loans, the cash flow statement will tell us whether it has paid off or it has enough cash to pay off this loan that it is owing. So this we can say, in retrospect, the cash flow statement is the connective tissue between the balance sheet and the income statement. Why do I say so? Because it will tell us whether there is enough cash to be able to know. When we say the current assets are the assets that can be converted to cash within 1 year. So when we'll be able to know whether this company has this cash and whether it is yet to be received, or it is in the bank. Cash in the bank, the more cash in the bank, the better the company. So we can say the cash flow statement joins both together. It joins them both. It makes us know how well the company is doing. So in conclusion, understanding these three financial statements and how they work together will allow us assess the financial health and viability and prospects of a company or an enterprise. And they help us make rational, fact-based investment decisions. When I say rational, fact-based decisions, when I started investing in the stock market, I started buying companies that I felt emotionally attached to. I liked Coca-Cola, so I wanted to buy Coca-Cola I liked Zoom without looking at the financial statement. I just liked many of these companies. I didn't literally look deep into Tesla. I bought Tesla. I liked Tesla too because it was popular. But there was no fact-based reason why I'm getting this company. Tesla has been carrying on debt over time. They've been carrying on debt. I don't know how they plan to. But when you start listening, when you start looking at these financial statements, you'll be able to see, wow, Tesla has been on negative net income for the past 5 years and they've not been making any money. Per se, they don't have literal cash with them. So when you know all these things, you'll be able to see that there are actually better companies out there with good financials and good financial ratios. You'll be able to make fact-based, not emotional-based decisions. So, Golearners, in the next module, we are going to be talking on how to pick stocks using this information I just gave. See you in the next module.